Have you ever really stopped to think about what a bank is? I mean, beyond just a place to keep your money. It's so easy to just picture these giant vaults filled with cash, right? But the reality, well, it's way more complex and honestly pretty fascinating. You see, accounting for a bank isn't just about counting money. It's a really sophisticated system that's built to manage one thing above everything else: risk. So how on earth does it all work? Well, let's dive in and find out.
So to get our heads around this, let's start with a really simple question. How is a bank's business any different from, say, your local coffee shop? I mean, think about it. They both have assets, they both have liabilities, and they're both trying to make a profit. But when you get right down to it, the very nature of what they do is just worlds apart.
Okay, so your coffee shop sells you a physical thing, a latte, a croissant. Its main assets are the espresso machine, the furniture, all those bags of coffee beans. And its liabilities? That's what it owes its suppliers. A bank, though? A bank is what we call a financial intermediary. Its product is money itself. Its primary assets aren't machines, they're financial instruments, things like loans. And its single biggest liability? Well, that's our money. All of it. The customer deposits. And that one simple difference, it changes everything.
All right, so in this explainer, we're literally going to follow the money. We'll kick things off with why banks are so different. Then we'll look at where their money comes from, their liabilities, and where it goes, their assets. Then we're going to get into the most critical part, how they account for risk. We'll see how they actually make a profit from all this. And finally, we'll check out a completely different model, Islamic banking.
So first step, why are banks so different? Well, it really all boils down to their core business model.
At its heart, what a bank does is a pretty simple three-step process. First, they raise funds. They do this by accepting deposits from people and businesses like you and me. Now, that money is a liability on their books because, hey, they owe it back to us, right? Second, they deploy those funds. They create loans for borrowers, which become assets for the bank because those loans represent a future stream of income. And third, and this is the key part, they profit from the spread, that little gap between the interest they earn on the loans and the interest they have to pay out on our deposits.
So let's start our journey on the liability side of the balance sheet. Where does a bank get its raw materials, its working capital?
The answer is really simple. It comes from us. Customer deposits are the absolute lifeblood of a conventional bank. Every time you deposit a paycheck into your checking account or move some cash into savings, you are providing the fuel that makes the entire banking engine run. But for the bank, it's crucial to remember this isn't their money to keep. It's a massive liability, a debt they owe to every single one of their depositors.
And the accounting for this is super precise. When you first make a deposit, the bank records it at what's called fair value, which is just a fancy way of saying the exact amount of cash you gave them. Simple enough. But after that, they use a method called amortized cost. Just think of it like this. It's your original deposit plus any interest the bank has promised to pay you, all spread out neatly over time. It gives a really true picture of what the bank owes you at any given moment.
Okay, so the bank has our deposits. Now what? Let's flip over to the asset side of the balance sheet and see exactly how they put that money to work.
A bank's assets are basically a big portfolio of financial stuff. Sure, they hold some cash and other investments, but the single most important category, their primary asset, is loans and advances. This is the real core of their business. It's all about turning the liability of your deposit into an income-generating asset, like a mortgage for a new home, a car loan, or a loan to help a small business grow.
Now here's where things get really clever. When a bank calculates the income it's making, it doesn't just look at the simple interest rate on a loan. No, it uses something called the effective interest rate method. Imagine you take out a loan, but there's some kind of processing fee tacked on. The EIR method actually bundles that fee in with the regular interest payments to figure out the true return the bank earns over the entire life of the loan. It's like the difference between a car sticker price and the real all-in cost, giving the bank a much more honest picture of its income.
This brings us right to the heart of the matter. Lending money is, inherently risky. What if the borrower can't pay it back? This is where bank accounting stops being just about numbers and becomes a kind of financial crystal ball.
You see, the central challenge for any bank is managing what's called credit risk. It's that fundamental risk that a borrower is going to default on their loan, which would cause a big financial loss. Pretty much the entire accounting framework for banks is built around one thing: identifying, measuring, and preparing for this exact risk. And here's where that crystal ball comes in. Modern accounting standards have a pretty radical idea. They don't want banks to wait around for a loan to actually go bad. Instead, the rules require banks to recognize expected credit losses.
In other words, they have to try and predict the future, estimating potential losses from the very moment a loan is even created.
So how in the world do they do that? Well, they use a three-stage model. Think of it like a weather forecast for each loan. In stage 1, the loan is performing just fine. Let's call it clear skies. But even so, the bank sets aside a small provision for a 12-month expected loss, just in case. Now, if the borrower's financial situation gets worse, the loan moves to stage 2. The risk is significantly increased. You could say storm clouds are gathering. At this point, the bank has to recognize the expected loss over the entire lifetime of the loan. Finally, you have stage 3. This is when the loan is impaired, it's non-performing. The storm is hit. The bank recognizes the full lifetime loss and even changes how it calculates its interest income.
Okay, so now that we've got a handle on the assets, the liabilities, and the risk, let's put it all together. How does this all translate into the bottom line? How do banks actually make a profit?
The core measure of a bank's profitability is actually beautifully simple. You just take their interest income, that's everything they earn from their loans, and you subtract their interest expense. That's what they have to pay out to all of us depositors. What's left over is the net interest income, or NII.
And this chart really shows you everything you need to know. See that big bar on the left? That's all the income the bank is earning from its assets, its loans. The smaller bar next to it, that's what it has to pay out in interest on our deposits. And that gap in between, that's it. That's the bank's core profit. It's basically the reward for successfully managing the risk of connecting savers with borrowers.
But here's the thing. The model we've just described, this whole system based on charging interest, it isn't the only game in town. To really get the full picture, let's explore a fascinating alternative that operates under a completely different set of rules: Islamic banking.
At its very core, Islamic finance is built on the idea that money itself shouldn't just magically create more money out of thin air. So charging interest, which is known as riba, is prohibited. Instead, every single financial transaction has to be linked to a real, tangible asset or a service. And this leads to a massive difference in how risk is handled. A conventional bank tries to transfer risk away from itself, but Islamic finance is often about sharing that risk between the bank and the customer. So the bank doesn't earn interest income, it earns a profit from a sale or rent from a lease.
So how does that actually work in practice? Well, it's all done through specific types of contracts. For example, with a murabaha contract for a house, the bank doesn't lend you money. It actually buys the house itself and then sells it to you at a marked up price, which you then pay off in installments. Or you have mudaraba, which is like a partnership, where the bank provides the money, an entrepreneur provides the expertise, and they share any profits. It's all about finding clever ways to finance things without using interest.
So as we start to wrap this up, it becomes really clear that the rules for bank accounting aren't just some boring technical details for accountants to worry about. Whether you're looking at the forward-looking risk models or the asset-backed contracts in Islamic finance, what you're really seeing is a sophisticated system designed to make risk visible and ultimately to maintain financial stability for all of us.
Which leaves us with one last thought to chew on. When you look at a bank's incredibly dense financial statements, are you just seeing a random set of numbers? Or are you actually looking at a vital sign, a real-time measure of risk, of confidence, and of the overall health of our entire economy?